Hey, welcome back everyone. It is time for another red hot covered call video. Hey, look, as 2018 turns into 2019, one of the things we're going to be talking about next year is the protective put, or what they call the married put. And usually what that means is you buy a stock and you immediately buy that protective put underneath it. You increase your cost basis, but you minimize your risk. Now I'm going to explain this straight talk style here in a minute, but going forward in 2019, we need to protect against these huge swings in volatility because, in my opinion, I think the stock market trades sideways next year. We're going to have these bits of volatility, and the only way we can protect ourselves is if we up our game with different strategies that help us protect our profits. And that's what we're going to talk about here in this video. We're going to talk about the protective put, married put with a covered call strategy. Now, before I get going, in this video, I'm going to talk about a mindset. I'm going to talk about discussions I had with Jerry about this topic. I'm going to show you my recent volatility trade on Adobe, and I'm going to give you that Jerry trade I promised you in my last video where he uses a 6-month covered call, knocking down the profits using exit strategy. But hey, look, if this is the first time you've ever been to my channel, I want you to subscribe to my channel. It's right there and it's free. And hey, look, if you like this video today, I want you to bang that like button because it lets me know you like what I'm doing. And what we're doing is this. We're updating the CTP dashboard every week. I just did, and there has to be 25 plus stocks that are brand new. Check it out. You cats are always asking me for that next red hot cover call stock. Well, hey, it begins with your research, and the CTP dashboard was built for just that reason. So I can load it up with the best stocks trading now, and I can further my research. See, we research our stocks so we can own it, we can feel it. Because look, when the stocks move lower and you're wondering why you're in that position, you need to know, you need to own it, and the only way you do that is if you research it. If you just get some email alert of what stock to buy, that does not help you up your game, because when that stock falls, we find ourselves in that very demoralizing position where we're absolutely kicked in the nads and we don't know why. So I want you to have a great starting point so you can do your research, and that's what I do with the CTP dashboard. And to get that, all you have to do is go to free dashboard and download your copy today. And if you haven't been to my Facebook page, I want you to go there as well. Search Facebook, CTP dashboard, and join the off YouTube discussion. More and more people are engaging. They want a place to go with like-minded people. Remember I told you in the beginning of this video we're going to talk about mindset? Well, that's part of it. Having that forum of like-minded people where you can openly talk about these things. Hey, look, that's hard. You know, I was just talking about Buddy Spence Friday night. We were talking about stocks and his retirement and things like that. He was asking me about what it takes to be successful. And I'm sure what he was expecting to hear was how to buy this great stock and run it up. But usually when I get asked those questions, I always fall back on my wisdom and experience because I've been doing this since the late 90s. And the one thing that I've noticed, if you have that community of like-minded people, you could ask questions, right? You find those trusted friends like I found Jerry. You could ask those questions, get those answers, and feel like there's no judgment. You feel comfortable, and you could have a great discussion. And, you know, for Jerry and I, we talk about this stuff as if it were a couple guys sitting in a bar, don't know each other, talking about sports. You know what I'm talking about. Guys that know nothing about each other, but they could talk about the Pittsburgh Steelers defensive front for the next 3 hours. Trying to find somebody to talk stocks like that is hard. Man, their eyes gloss over. I've found over the past years that I just can't talk to people about this stuff because once I get going, I could dominate the conversation and immediately it goes straight over their heads. And hell, I've probably done that in many of my videos right here. So I don't really even offer up an opinion because I don't want to dominate the conversation. So I really have to throttle down my excitement because for me, this is exciting. This is a passion. This is more than a hobby. I treat it like a business. So for me, that's important to have that person that you could talk, you could share ideas, and I'll tell you, that comfort level and that mindset, boy, I'll tell you, it's just going to help your game. Try to find that person. And hell, maybe you'll find them over at my Facebook page, ctpdashboard.com. Now, let's go ahead and get to this video talking about the protective put and how we're going to use covered calls to reduce our costs. But more importantly, it's going to be a strategy that we're going to use in 2019 that I think is going to up your game. Now, let me lay some basic groundwork for what this strategy is all about. And trust me, I've watched about 10 videos on this topic because at first I thought this was much more complicated than it was, but it's really not. So that's why I'm going to give it to you straight talk style because I don't want you to watch 10 videos like I did, basically finding out that this really isn't complicated. But it could help us in our game, reducing our risk. It does add to our cost basis. But with that said, we always have to have another tool in our experience toolkit, right? I always talk about this all the time. You have to have your financial education. You have to have your experience. Well, we go to work with a toolbox. And in that toolbox, we have things like exit strategies and rolling over our options and maybe buying some more stock or using the cash secured put. That toolkit is going to provide us with the tools we need to hopefully have a green trade. Well, the protective put or married put is one that we're going to use in 2019. So let's talk about the basics of the trade, straight talk style. And if you're interested in hearing a great video on this topic, I'm going to post this in the description below. This video right here, buying protective puts to reduce your risk, is one that I'm going to suggest you watch. Now, like I always tell you, I've never used the trading service we're talking about, and this guy doesn't pay me. This is just a great video that I want to share with you to up your game. So let's talk about the basics here so you understand. So as you'll see in this video, he's going to talk about buying XYZ at 65 bucks, right? We all understand that. We buy the stock and we understand we buy the risk. Stock could fall day one and you're down. Now the stock could move higher and you're up and feeling good, right? But most people focus on that downside move and they're really cautious about how they can protect themselves. Well, buying a put, remember, we sell premium on this channel, but in this case, we're going to buy a put. Now, what does that mean? When we buy a put, we are buying the right from somebody to stick somebody with shares at a certain price. Now, you have to have your brokerage account set up at a higher level. So if you just have the basic brokerage account to write covered calls, chances are you can't buy puts, right? So you're going to have to change your brokerage account status to a more aggressive strategy. So you'll want to call your brokerage and talk to them about that. The protective put we're buying is going to allow us, or it's going to give us that ability to put somebody some shares at a certain price. In this case, he bought the shares at 65 and he uses the example of buying that put at 62.50. And I think he paid $1.50 in this video. So what does that mean? Okay, he bought the shares at 65, so that's going to cost him $6,500. Then he bought that naked put or that protective put at 62.50 for $1.50. And what that means is if the stock falls and whoever this person is who bought that protective put can put that person to that stock for 62.50. So in a sense, that reduces the risk on this trade, right? The 100 shares purchased at 65, it reduces the loss to 62.50. Now you have to add the $1.50 for the cost of the put. And that's going to add to our cost basis, like I said earlier. So really, when he took on this trade right here, he paid $65 and he paid the $1.50 for the protective put. His real cost basis is $66.50. It protects him because should the stock fall below $62.50, he don't lose any more money. That's where that protective put comes in. Mind you, you'll hear people talk about a married put. This is the same strategy. They're just using the lingo different, but it's the same strategy. Married put, you're marrying a stock purchase with buying a put option, limiting your risk. Now, you can do this at the point of execution. You could actually go to your brokerage and say, I want the 100 shares plus I want this put, and they combine it together, they do it at once, and you're immediately protected. But the most common way to use this is to buy the shares and maybe you get a couple green days, then you put on the put. Now, I'm not recommending you do that, but that's just what they say is the most common use of this. The reality is, if you're going to use this strategy, you need to buy that put. And maybe at the point of execution is the time to do it. And that's going to be the married put or protective put we talked about. Now, I'm being super simple in my explanation of this because I know a lot of you cats out there don't understand this concept. I know a lot of you salty dogs are out there saying, look, I get it. Talk to me about the married put with a covered call strategy because that's where I want to learn something. And that's what we're going to talk about now. We're going to use this married put strategy, but what we're going to do, because we own the 100 shares, is we're going to write a covered call, selling somebody the right to buy our shares at a higher price, collecting the premium, offsetting that $1.50 cost for the protective put. So let me show you what that looks like on this same chart right here. So I buy the shares at 65. I buy the protective put, adding to my cost basis of $1.50. I have that downside protection. I have that true downside protection at $62.50, but now I'm going to write that covered call. I'm going to write that 30-day out of the money covered call with the idea that our shares are going to be taken away higher. I mean, that's the hope, right? But in this case, we're adding another feature to this trade that's going to reduce our profitability. And the reason we're reducing our profitability is because we're adding that protective put. Now we have to pay for that. So in this case, I bought the shares at 65. I'm going to sell somebody the right but not the obligation to take those shares from me at 67.50, and I'm going to get $2 premium for that. So in this trade, you could see a couple things here. One, the $2 premium I get for the covered call right is actually going to pay for the protective put. So I actually make 50 cents when you deduct the $1.50 from the $2. Then what am I left with? Well, I own the shares at 65 and I'm getting 67.50. So my true profit is going to be the $2.50 from 65 to 67.50. That's $2.50 plus the 50-cent remainder when I deduct the $1.50 from the $2 premium. I'm making $3 on this trade, but I eliminated a ton of risk. And that's how this married put strategy with the covered call is used. But here's the wrinkle that I'm going to introduce to you that I'm going to use this year. Now, this is a 30-day trade, and that window's tight. And here's the deal. And chances are, if the stock were to stay flat or fall a little bit, that $2 premium that we got paid for the cover call, it's going to reduce down to zero, right? Because as we get close to the expiration of 67.50, it's not going to get there. So that option is going to decay, right? The time value is going to decay. We won't be at 67.50. We'll have no real money in the option. So this thing ends at zero. Now, what does that mean? We collect the $2 premium. We keep that in our pocket. We paid the $1.50 for the protective put. So our net from that is 50 cents. But here's what I'm going to do. I'm going to go out 6 months. I'm going to pay upfront costs on that protective put much further. And what I'm going to do for the next 6 months is I'm going to use the cover call strategy where I'm going to use my buybacks to never have my shares taken away. And I'm going to always buy back my options when the options fall, when the stock starts to fall. If the stock that I bought at 65 falls to 61, that doesn't mean I'm going to exercise the put at 62.50 at that point. Hey, I bought the stock. What's our golden rule? We buy the stock, we own the stock, we want to own the stock. What I'm going to do is trade this stock. So when it falls to 61, I'm going to write the 64 covered call, picking up another $2. Look, buy the stock at 65. It's fallen. I write the covered call. We buy the option back. Goes higher. We write the next covered call. We buy it back. We do this time and time again, like I show you in my videos all the time, having this protective put in our hand where we could actually stick somebody with the shares at 62.50. But the hopes here is that we have written covered calls along the way, pocketing all those premiums, and maybe even picking up dividends along the way, right? Because we're going to buy that 6-month protective put, and chances are we might be able to pick up a dividend along the way. So this is how I'm going to use the married put with a covered call strategy. Now, this video here is, quite frankly, a little bit of a primer into what we're going to do this year, because I'm going to be talking about this strategy. And I'm actually going to show you real trades of this as we get into 2019. So I need you to subscribe to the channel, because I get a lot of people in my comments saying you should use the married put or the protective put. And for the most part, I brushed it off because I didn't want to add to my cost basis. Maybe I didn't quite understand how I could play the difference, so I just neglected to even look into it. But with some of my stocks this year where I bought high and they fell some 30 and 40 points, look, paying up front for a little bit of protection would have saved my year on some of those stocks. Now, let's talk about that quick Adobe trade I did Friday. Then I'll quickly move into the WYNN trade that I promised you last week. And yeah, it's deja vu all over again. And I know this is getting old for you, right? This is real for me, and it is unbelievable that we can use a great company, knock down some short-term volatile profits using the cash secured put and the covered call. And I did that on Friday. Let me step back to this trade right here. A couple videos ago, I told you how when Adobe fell some 20 points, I sold an at the money 220 cash secured put and got paid $12. Now, I did this for 30 days. I'm thinking, look, Adobe is not going to stay around 220. The markets will rebound. This thing's going to go higher. I'm going to be able to buy this option back for less than $12. I'm going to pocket the difference for a short-term gain. And that's exactly what happened. But before I did that, when it was trading at 219, I bought 100 shares thinking, look, I want to own Adobe, so this is a great time to buy some shares. So that's what I did. And what happens almost the very next day? Adobe starts to move higher. This option gets to $8 real quick and almost pulled the trigger to buy it back. Cherry picking those quick profits. profits, but I didn't. I told Jerry, I am sticking in for this trade, and that's exactly what I did. We wake up the next day and the markets are rallying. Now Adobe's rallying. And then Salesforce.com announces earnings, and Adobe is now touching $2.50. And this option here that I got paid $12 gets to $1.90. I left some money on the table by buying it back too early, but before it rocketed, 1 in the hand versus 2 in the bush, right? So I bought that $12 option back for $1.90. We move on. Well, the day before, I wrote a cover when Adobe was trading at about $2.35. I think I got $4 for that. And of course, when it goes to $2.50, I have my shares taken away. Man, this was a profitable trade. Well, fast forward to Friday, and we have had multiple down days on the stock market for various different reasons. So when Adobe fell some 14 and 15 points just Friday, I'm thinking to myself, this is a great opportunity to do this again. So that's what I did. When Adobe fell down to $2.39, I went ahead and wrote 30-day $2.35 cash secured put. I got paid $11.50. That means if Adobe falls below $2.35, by time of expiration next month, that person can stick me with Adobe shares at $2.35. Well, I don't mind holding Adobe. I want to own Adobe. So for me, I took that trade and I added $11.50 to my wallet. And here's the deal. If Adobe does fall, at least I have $11.50 in my pocket, reducing my cost basis even further. Now, I'm thinking, we have had a lot of selling recently, and I just think this is not going to hold. So I bought 100 shares of Adobe at $2.39. And I'm thinking if we get a turnaround again, I'm going to do the same thing. I'm going to write an out of the money covered call, picking up about another $4. We're going to buy back the cash secured put of $11.50 for as low as we can get. And I'm going to have my shares taken away as Adobe goes through my strike price on my covered call, pocketing that premium as well. Look, I have no crystal ball. I make no predictions, and I don't even recommend any stocks. That's not what we do here. I show you my trades, we talk about them, and maybe you learn something. Now let's talk about that WYNN trade real quick Jerry did to give you a little light on how he uses the 6-month covered call with exit strategies, pocket money throughout the year. Okay, so let me give you a little backstory on this because I can't just jump right into it. What Jerry has been doing throughout the year is just buying WYNN as it's gone from $100 to $200. And what Jerry will do, because he wants those big fat premiums, and he knows WYNN will go up and down, and sometimes it'll go down more before it shoots higher. WYNN does this, and lately WYNN has been doing it to the downside more than the upside. So this has been the topic of conversation all year. But what Jerry does, and he still does it today, is that he will write that 6-month covered call. Now, if you look at an options chain, WYNN will pay anywhere from $9 and $11 for an out of the money covered call, maybe a $10 or $15 out of the money covered call. Now, right now, if you go to the options chain, you won't see that. But during the year, this is what he would do. And he would collect that premium, and then he would wait. And if he had his shares taken away higher, then he'd make that profit and move on. But what he found throughout the year is this. As he would write those covered calls, as it's moving higher, he would get max premium for that covered call right. Then WYNN would do what it normally does, and it would peel off. This $11 premium would fall to $9, $8, and he would not hesitate. He'd buy it back, and he would look to do it again. Think about that for a second. He's owning the shares. He's writing a deep out of the money covered call, a 6-month covered call, giving the option holder 6 months to make this decision. So those premiums are going to be nice and juicy. Well, he sells that covered call at the top of the range. So he gets max premium in the hopes that as it rallies higher, he sells the covered call and it starts to peel off. He doesn't really even need it to peel off that much. And that rich $11 premium will peel off to $9 or $8. Well, think about it. He picks up 3 points and he pockets it. He has his shares. He looks to do it again. And he did this so many times last year, even with WYNN down some 100 points. He has a profit in WYNN and he's still doing it now. So the takeaway from this trade is this. Because he's going to own WYNN all year long, and he's going to own it whether it goes higher or lower, what he likes to do with WYNN, find that point in the trading range, usually on the high end of the Keltner channel, and he'll go ahead and write the 6-month covered call, collecting the fat premium with the idea that the stock is going to fall. And it doesn't even have to fall to the bottom of the Keltner channel. It just has to make a little bit of move towards the middle. He's going to be able to buy back maybe 3 or 4 points of the $11 premium he got paid. He alleviates that obligation, and then as WYNN moves to the upper line of the Keltner channel, he'll do it again. He'll do it again. Now, I do this in a 30-day period, and because the window is tighter in 30 days, I have less risk in this. He'll tell you, and in fact, he told me this Friday, that there is risk. You're holding 6 months worth of risk and dead money. Because what he'll tell you is this: when he writes that out of the money covered call at, let's say, 140 on WYNN, and he writes that 155 and he gets paid $11, and WYNN goes to 200, well, at that point, WYNN has moved too high to buy it back, adding to his cost basis. He's sitting there holding WYNN for the duration of the covered call, making no more money above 155 plus his premium, which would be in this case about 166. So when it goes to 200, he misses all of that upside. Now look, I hope you like this video, and if you like the married put with covered call strategy discussion, we're going to be talking more about that on the Facebook page and right here on the channel. So I want you to come back. I want you to be a part of that. Hey look, I hope you like this video, and if you did, I want you to bang that like button, and look, ring my bell so you get my email notification the next time I do a red hot covered call video. And until next time, I hope all your covered calls are profitable.